Hello, my name is Anko and today I'm gonna talk about how I made this huge mistake buying my first house. So I had all this money saved up and I was like, great, now I don't have to take this big of a loan for buying this house, which is called a mortgage. And I thought this was a great idea at the time, because if the loan is smaller, I can pay it off faster and I would be debt-free a lot sooner, which sounded like a great plan in my head at the time. So let's say my house cost 300,000 euros and I had saved 200,000 euros and I needed to loan 100,000 euros from the bank. And I took out a mortgage of 25 years at an interest rate of 1.15%. I need to pay the bank 383.43 euros each month. And after 25 years, the bank will have earned 15,000 euros of simple interest from me. But let's say instead of loaning just 100,000 euros, I loan the full amount of 300,000 euros, which is the full amount of the value of the house. Then I will have to pay the bank 1,150 euros each month. And the bank will earn 45,000 euros for me over the runtime of 25 years. But I will still have my 200,000 euros of savings left to invest. And let's say I invested that 200,000 euros into an ETF like VWCE at an average annual return of 12.9%. After 25 years, my 200,000 euros would have turned into 4,153,158.86 euros through the magic of compounded interest. I know what you're thinking. You're thinking, yeah! I'm gonna make bank, baby! Now, hold on, cowboy, not that fast. There are still two little pitfalls that you need to pass. Be aware, I am not a financial advisor and this is not financial advice, so do your own research as investing is risky. The first pitfall, stocks crash. But the longer your investment horizon, the more spread out the risk is. But you could be a bad luck Brian. Say you are waiting for your official retirement before cashing out your ETF. But then 1 year before your retirement, a financial crisis breaks out, the stocks take a dive, and your money goes down the drain with it. Please hit the like button so you can enjoy a picture of my dream house. The second pitfall, banks don't promote this, but yearly they only approve 5% of mortgage loans that loan 100% of the value of the house. The banks do choose these themselves and it depends on the following criteria if you are taking in consideration or not. How much do you earn? And how much can you pay back each month? You cannot loan more than the price of your house. What kind of job you have? Your education? What amount do you already have saved up in your savings account? What guarantees can you give your bank? Like giving the bank the right to sell your house if you're not able to pay back your credit. The younger you are, the better, as you can be seen as a future big earner. Leave a comment if you made the same mistake. I'm not going into buying versus renting homes right now, but I might in the future. Go out.